In today's video, we'll be discussing the role of money supply and its impact on inflation. By tracking the year-on-year changes in the growth rate of money supply, we'll find out why the US, the Euro area, and Japan witnessed a surge in consumer prices, while China's inflation remained stagnant. It's going to be an engaging discussion, so make sure to stay tuned for interesting insights. We begin by looking at this chart which tracks the inflation rates across the four major economies. Let's examine the data closely. In the US, inflation rose from 2% year-on-year in February 2021 to a peak of 9% in June 2022. For the Euro area, inflation surged from 1% year-on-year to 10% in October 2022. Even in Japan, which has a history of moderate inflation, consumer prices increased to 4% year-on-year in January 2023, far above its 2% year-on-year average. Now, let's turn our attention to China, the second largest economy. Unlike the US, Japan, and the Euro area, China's inflation rate has shown a distinct pattern. Instead of experiencing an acceleration, China's inflation rate has remained remarkably stable. In fact, it slowed to 0% in June this year. Let's uncover the reasons behind the significant difference in consumer prices between China and other major economies. In our view, we can gain a clearer understanding of this phenomenon by examining their respective money supply figures. For those familiar with basic economics, this concept might not be surprising, as inflation is often defined as too much money chasing too few goods. As Milton Friedman, the Nobel laureate in economics in 1990 famously put it, inflation is always and everywhere a monetary phenomenon. This chart here tracks the growth of M2 in the US, Euro area, and Japan over the past decade. For viewers who are not familiar with economic terms, M2 is a broader measure of the money supply compared to M1. M1 refers to the physical currency in our pockets and checking accounts in the bank. M2, on the other hand, includes not only M1 but also a wider range of financial assets that are readily available for spending or investment. M2 helps economists and policymakers understand the amount of money available for people and businesses to use for transactions, investments, and savings. Put simply, changes in M2 growth have repercussions on the inflation rate. In 2021, something extraordinary occurred in these economies, particularly in the US. Looking at this chart, M2 growth experienced a remarkable surge, reaching an unprecedented peak of 25% year-on-year in February. Japan and the Euro area also witnessed faster M2 expansion compared to the period before 2021, though not as much as the US. Japan, for instance, had M2 growth rising close to 10% year-on-year in March. As Japan's M2 growth was slower than that of the US and Euro area, it is arguably the reason why the country's inflation rate is lower. Let's now turn our attention briefly to Turkey, where we find another real-world example of what can happen to inflation when money supply growth is allowed to accelerate uncontrollably. Turkey's unorthodox monetary policy involved consistent interest rate cuts to boost the economy. However, this led to a sharp increase in money supply. As the chart shows, M2 growth surged from 20% year-on-year in September 2021 to a staggering 80% at its peak in August of the same year, significantly increasing inflation rates. In this context, let's take a look at China's position. Interestingly, China's M2 growth hasn't shown any signs of acceleration, sharply contrasting the US. Not only is China's monetary growth slower than that of the US, but it's also considerably slower than the period following the 2008 global financial crisis. Back then, China's M2 surged to a peak of 30% year-on-year in November 2009. However, things have changed since then. As of June this year, China's M2 growth has slid to just 11% year-on-year. To understand why China's inflation rate and money supply differ from that of the US and the other economies, we can simply look at their respective central bank balance sheets. During the pandemic period, the central banks in the US, Japan, and the Euro area implemented extraordinary stimulus measures. They expanded their balance sheets, meaning that the Federal Reserve, European Central Bank, and the Bank of Japan were all injecting money into their banking systems. In contrast to the other major central banks, the People's Bank of China (PBOC) took a different approach during the pandemic, treating the pandemic almost as if it was business as usual. While the balance sheets of the other major central banks expanded significantly due to extraordinary stimulus measures, the PBOC's balance sheet remained relatively stagnant. Moreover, it was nowhere near the level of action taken following the global financial crisis. Another interesting perspective on the PBOC's actions can be seen in this standalone chart. This chart displays the size of the PBOC's total assets, which underwent rapid expansion from mid-2007 to the end of 2011. During this period, the PBOC's balance sheet ballooned from 14.8 trillion RMB to 28.1 trillion RMB, marking an increase of 13.3 trillion RMB. To put this into perspective, let's compare it to the period from the start of the pandemic in December 2019 to June this year. During this time, the PBOC's balance sheet increased by just 4.4 trillion RMB only. Looking ahead, what can we say about global inflation based on these charts? Considering the significant role that money supply plays in explaining inflation trends, the downtrend in M2 growth since June 2021 augurs well for the inflation outlook. Both the Federal Reserve and the European Central Bank have halted and even reversed their policies of expanding their balance sheets. In simple terms, the situation of too much money chasing too few goods is now being reversed. This development bodes well for a softer inflation scenario ahead. And that concludes our analysis of the impact of money supply on inflation and the crucial role played by central banks. We hope this has deepened your understanding of how changes in money supply and central bank policies can significantly influence economic outcomes. If you found this video helpful, please give it a thumbs up and share it with others who are interested in understanding global economic and financial developments. For our subscribers, we'll provide the statistical sources for all the charts featured in this video, so be sure to hit that subscribe button. And as always, feel free to leave your questions and comments below. We value your input. Stay tuned for more insightful discussions on various economic topics in our upcoming videos. Thank you for watching and see you in our next video.